All right, everyone, we're back. Earnings expectations. So, in the last little mini session, we talked about how earnings can be a really awesome, extra profitable strategy to the overall portfolio and to your overall returns. Typically, most strategies that we employ, as you guys know, are with 50 days in mind. So 50 days until these options expire. Sometimes it's a little bit more, sometimes it's a little bit less. However, earnings are interesting because they are overnight. As you know, earnings are these binary events that see the expected move get completely removed overnight. So all of that premium that's built into the options gets removed almost overnight. So again, we sell options because the expected move is what options are priced off of. That expected move overstates the actual move and has for the last 100 years. That's why we sell them. And again, in a lot of cases, we do that looking out 50 days, but with earnings, we can do that overnight in a lot of cases. So again, we know that the expected move over a 50-day period typically overstates the actual move, right? And this is obviously our edge. This is our edge. This is why we sell options, because we sell something that we know is overpriced, right? But what about earnings, right? And what about that one-day move? We know the 50-day expected move is overstated, but what about the one-day move, right? That's a completely different time frame. We haven't talked about that before, right? But the truth is, if the expected one-day move overstates the actual one-day move, we will also have confidence that we have an edge in selling options during earnings trades, right? So we have a lot of confidence at this point. If you made it this far, Market Hero, you should have a lot of confidence that these strategies that we're talking about, specifically the ones that look out 50 days in the future, are excellent strategies. And anytime you find one of these setups, you should be employing them to the best of your ability. Obviously, staying very small and doing that, but you should be employing them because you know you have an edge, right? But what about that overnight play? Do we really have that big of an edge overnight, or do we not? Because again, in 50 days, we have time to massage trades. We have time to roll down the untested side, to continue to make our break evens larger, right? To continue to add premium and expand our credit, right? But overnight, we aren't afforded that opportunity. So how overstated, if it is at all, to the expected move is the actual move, or excuse me, how understated is it, right? Or how overstated is the expected move to the actual move, and thus how profitable can these strategies be? So we did a study, as you guys know, so 2003 to present, so about 14 and a half plus years of data, depending on when you're watching this. In Apple, Facebook, Netflix, Google, Microsoft, Yahoo, Goldman Sachs, Bank of America, United Airlines, JP Morgan, right? So that's about 500 occurrences, and again, some of these stocks don't go back to 2003, right? Facebook doesn't go back to 2003. Not sure if Google goes all the way back to 2003, but whatever it is, right? So 4 times a year for all of these strategies, right? For all of these stocks, we would go back and what we do is we calculate the one-day expected move in earnings, right? And then what we did was we noted if prices opened between or outside of that one-day expected move, right? So again, the expected move should occur 68% of the time, right? Again, markets are random, right? And in a normal distribution curve setting, prices will fall within the expected move or one standard deviation 68% of the time, right? So the expected move in earnings should occur 68% of the time, right? So all we did was we said, what's the expected move? Then where they open the next morning, did it fall within the expected move, right? So as you can see, about 71.5% of the time, they fell within the one-day expected move, right? So again, they're supposed to fall within the expected move 68% of the time. They fall within the expected move 71.5% of the time. So that's pretty good. We're definitely onto something. To me, this much of an edge isn't the most amazing thing. However, this gets the ball rolling for us. This really gets the ball rolling for us. So we did the same study almost, right? Same stocks, Apple, Facebook, Netflix, Google, Microsoft, Yahoo, Goldman Sachs, Bank of America, United Airlines, and JP Morgan, right? So what we did this time was, again, we calculated the one-day expected move. Number one, we noted if prices open within or outside the earnings one-day expected move. And at the same time, we noted if prices open within or outside the earnings one-day expected move, plus our credit received for selling the expected move strangle, right? So if we go to, let's say we go to Apple as an example, right? Let's go to Apple and let's go to this September 22nd expiration cycle, right? So the expected move, right, is down to 155 and up to 162.5, right? So for the first part of this study, we'd be looking to see, right, if prices open within or outside the earnings one-day expected move, right? We'd be looking to see is the next morning prices fell between 155 and 162.5, right? That's what we would be looking to do, right? And the second part of this is testing to see if they fell within that or outside of that, but with the addition of the credit for selling the expected move signal, right? So we're collecting 66 cents for doing this. So we would like to see at that point if they fell within our break evens, which in this case is 154.34 or 163.16. Now, this is not an earnings period, right? Usually the expected move is going to be a lot larger because volatility is going to run up, as you guys know, and the expected move is going to run up into the earnings announcements. But this is just as you can imagine. So remember, one of it, we're seeing if it falls within 162.5 and 155. The other, we're taking the 66 cent premium and we're adding it to our break even. So now it's 154.34 and 163.16. So those are the two things. Again, did they open within the expected move, or did they open within the expected move plus the credit received for selling a strangle, right? If you would sell the one standard deviation expected move strangle. So let's see how we did. So again, 71.5% of the time, the prices open up right within the expected move, right? And that's supposed to happen about 68% of the time, right? Now, we find out that 80.25% of the time, prices open up within the one-day expected move plus the credit received, right? So the way we can think about this, 71.5% of the time, prices fall within just the expected move. However, if we add the credit that we would receive for selling the one standard deviation or expected move strangle, which again is just the easiest way to bet that the expected move is going to overstate the actual move, right? We're right 80.25% of the time. So now it looks like a much, much more profitable strategy, right? Again, we have a nice little 15-20% edge in executing the strategy this way. This is really, really interesting, but let's try to take it a step further. So now, same stocks, same time frame. We're doing three things here, right? So the first thing we're going to do is we're going to note if prices open within or outside the one-day expected move, which you can see over here on the left, right? 71.5% of the time, they fall within the expected move. There's a little bit of an edge there, about 5%, not huge. The second thing we're going to do is note it if it opens up in the same range plus the credit received, and you can see 80.25% of the time, so about a 15-20% edge when we add the credit. And now we're going to see if both of these both of the two close the next day within a range, right? This study right here is just how did they open, right? The next study we're going to see is not just how do they open, but also what does it take the rest of the day? Do stocks move around after earnings? Do they stay within the expected move or not? Right? So you've seen this top up part before, right? They open up within the one-day expected move 71.5% of the time. They open up within the one-day expected move plus the credit received 80.25% of the time. However, if we just calculate what they look like at the end of the day, instead of being right 71.5% of the time when it's just opening up within the expected move, now we're only right 63.3% of the time. And we're significantly worse when we actually add the credit received to the closing price. Now we're only right 69% of the time, right? So very, very interesting. As a note here, what I see here is we think about earnings plays, and again, we'll get into earnings plays and exactly when to do them, how to do them, et cetera, in the next few lessons. But we are looking to execute these trades and get rid of them as soon as the prices of the options are able to trade. Obviously, we have a much, much, much bigger edge here, right? About a 15% edge if we take it off as soon as the options for the price open. Right, so very big deal, and again, we'll get to that later on here. So again, now we're going to take everything a step further, right? We're going to take everything we did a step further, right? We're going to see if prices open up within our expected move. We're going to see if prices open up within our break evens, which is the expected move plus the credit received. And then we're going to see how they close the day. So did they close the day within our expected move? Or did they close the day within our expected move plus the credit received, right? So our break evens. And now, again, we want to see if we did these in periods where volatility was greater than 50%. Now, the reality is, in a lot of these earnings cases, you guys will see, in a lot of these earnings cases, we will see that their high volatility happens most of the time. About 80% of the time, high volatility happens when earnings happens. That's really, really good for us because, again, when volatility is greater than average, options are even more overpriced than they normally are, right? So we want to compare in periods where volatility is greater than average. So just opening up within the 1 day expected move, we're supposed to be right 68% of the time. If you do it all the time, you're right 71.5% of the time. If you do it in periods of high volatility, you're right 76.2% of the time. So a really, really, really big edge there. However, again, it only happens about 80% of the time, which is still a lot. Now, if you're looking to see if prices open up within the 1 day expected move plus the credit received, then again, the difference here would be 66 cents. This is the expected move. This is the expected move plus the credit received, right? So if you want to see if they open within, you're supposed to be right 68% of the time. In periods of high volatility, 84.4% of the time. So awesome. However, when looking down at the bottom, executing these earnings strangles, which again, we're going to get into a lot of different strategies here in a minute. Executing these earnings strangles, which is just, again, a bet that the expected move is going to be greater than the actual move, is barely a dent better in periods of high volatility, right? So what did we learn from this little mini lesson here? And again, we're going to get to a lot of this into more depth later on. But number one, the first thing we learned is when we do these earnings plays, you want to take the play off as soon as options are able to trade on those stocks. The reason is because the longer you wait the rest of the day, you lose money. And the second thing is, in periods of high volatility, we absolutely want to be more aggressive with doing more earnings trades, right? They really, really help you when you take them off right after the options open for the stock the following day. They don't really help you much at all if you hold the options for the rest of the day. So I'll see you guys in the next video. A lot of cool things coming down here in a quick second.